All right, ladies and gentlemen, I hope you had a wonderful day. It was another day of carnage for the bonds and the dollar, and the market really felt it. Even if you pull out the daily, it's starting to look pretty ugly now. We were talking about selling pressure of September carrying over, but the real story is what's going on with bonds. So, you see the title of the video, the yield curve is uninverting, and we need to talk about this. At one point, when I make a video about the yield curve uninverting, it will be a lot more important than this video. However, what I am sharing with you today is the fact that there has been a lot of discussion about bonds. There was some action today. Yes, we responded to data, but now what is going on with bonds and what the bond market is saying, there are some things everybody should be aware of. Now, should you freak out? Is market fear incredibly high? Yes, it is right now, but I don't know. Maybe you could use me, you could short me or not, but I don't think it's that crazy just yet. But the things about the yield curve and moving forward in this next set of data that we get this week, remember the calendar, even next week, you get CPI and bank earnings. It is setting us up for a very wild earnings season. So, Chad, what I have for you is we are going to go over the yield curve today. I'm going to show you what happened, why people are freaking out. We keep bringing up the 10-year. There's been a lot of action, and even on the week, it is something that we need to discuss. Then I have a couple of plays for you, not anything too crazy, but what we do on the watch list, and that is going to be it. So what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there live in the morning. But Chad, let's get into the yield curve. So if you are not familiar with what even happened today, it's the same thing as the last couple of days. We are waking up. There is not much going on. The bonds are down, and either at open or right after open, they continue to sell off. All the while, the dollar has just been marching forward. So even today, it was the same story. The bonds were already down. Then right when the jobs data came out, it sent the bonds down. And what ended up happening, it was good jobs data. We talked about this yesterday. That meant it would support the rates going higher, and it indeed sent them vomiting downwards. So this wasn't good. That was the negativity. All the while, the dollar was up. There was actually a very crazy element of today, even though the Minister of Finance of Japan said no comment towards whether or not this was Japan intervening. This was the yen weakening right after our data. I got to zoom in a little bit. So this was right when the data came out. Markets were dropping, and it was about like 10 minutes, 12 minutes later, there was about a 1.5% pop on the yen. Some people are saying it's what happened when it hit 150, but, you know, it hit 150. It didn't have the knee-jerk reaction. This was intervention. This is at least my opinion. I was talking about this today, but it was very wild, and if anything, the dollar would have been absolutely wrecking, but the yen going up in value helped keep the dollar at bay. But that was all craziness of today. But the moral of the story, it was bonds, and we kept talking about this, and there's one thing I wanted everybody to notice, so maybe I'll come back to the chart here, but the thing about what has happened this week, IEF, that is the 10-year. TLT, this is 20-year plus, 20-year, 30-year. You could also watch this going down and then go to SHI. This is even the 1 to 3-year. They are all dropping. These charts dropping means that bond yields are going higher, but the one element that we need to talk about, and you'll see when I show you the yield curve, is that all this is saying is that we are not really reacting to any recession. And that may sound weird, and this is kind of the point I want to tell you about this video. One, do I think you should be freaking out right now? No. But what has been happening in this continued down streak, again, we have not seen this much continuous downside since around SVB, but all this is saying is that credit risks are increasing, and every single day this continues to happen. That's what it's showing. Where is the evidence? Where is the proof? It is all of these bonds going up in yield. What are you used to? If there's recession, something bad going up, people buy the bonds. Sadly, I have to even go beyond a 3-year chart to show you an example of this, but essentially, yes, every time you've seen the bonds showing recession and people would freak out, even last year you had more of that, but in the midst of this, with the bonds selling out, the 30-year going up, the 20-year, the 5-year, 10-year, all of it, it is saying that the credit risks are increasing, but that's increasing faster than anybody buying in for safety or people rushing in to buy bonds, aka people are worried about credit to the point they're not really buying things. That's why even gold and other safe havens, you're not watching those get bid up. So that's the main point of what I want to show you here, and that's why we got to go through the yield curve. So right here, and this might be able to show it to you, this is the yield curve, the 2-year, 10-year spread. This is the one I've made videos about on this channel for several years. I've at least give you some sort of update, even like this, at least like once a year, especially when it's going crazy. But the point that I want you to see here is how it has moved. And prior, when it's inverting, that's people worried about recession. You know, that's that whole 12 to 18 months when it first started to invert. That's when we first started seeing that. That was right, July 2022. So this is where it gets tricky, because for the last, how many years, it's been telling you recession, only things have gotten better. This is why a lot of people have difficulty reading the yield curve, and it's mysterious and elusive. But the way I've always told it, I think even Uncle has said it in songs, you wait till this thing uninverts, you know, when the 3-month is on the fall. But ironically enough, what is happening now, the curve is uninverting, but there is no signs of any rate cut, or at the very least, that's what Jerome Powell is saying in the Fed. But the thing I want you to notice about this, and related to that credit stuff, let's go back. You'll notice yield curve was getting inverted, deeply inverted, and then 2023, then all of a sudden the week of like February leading into like March 6th and March 12th, the yield curve magically uninverts by like 0.3, 0.4. It was very rapid. What was that? It was SVB, the only other period we look like this. So last time bond rates were doing anything of this nature, and it wasn't even close to what we have now. It's getting a lot worse here of what we've experienced. That led into the whole SVB crisis. So this is where I'm saying credit risk is on the rise with the yield curve, and to understand this yield curve a little bit better, if you don't know what it's saying, take a look at the 2-year bond. It's at 5.15 right now. The 10-year, 4.79. At one point, we even hit 4.81. It was crazy, but the whole idea, that is a gap of like 0.36. Why does that matter? Because this is how the yield curve looks right now, with shorter-term rates higher than longer-term rates. You could even go down to the 30. How it should normally look is where shorter-term rates are lower than long-term rates. That is a normal yield curve, not an inverted one. So what we're watching right now is it's pretty much flattening out. You're getting that steepening of the curve, but the 10-year is starting to rise up, and it's matching up with the 2. But now, here's something you got to understand. The curve may very well show up as inverted. The 2s and 10s may uninvert, but this is where the Fed comes into play, because take notice, short-term rates are still lower than the 2-year. This is something we've been talking about a lot. Even though I showed you the 2-year, that's at 5.15. Go to the Fed funds rate right now, that's going to be at like 5.5. So there's still a lot of progress, and this is now the fear and what's been going on, because this whole move, how fast the yield curve has even uninverted as of recently. You go look at let me take you to the 10-year. This chart right here is a 1-week chart. You went from 4.5 to now touching 4.8. You do that one more time, if we essentially have another week like what we just went through, where you see this pretty much September 27th from here to here. You do this one more time, which you did last week, and then you kind of did like a couple of weeks before at a much slower pace. This is why we're looking for that yield stabilization, because if that happens one more time, then the yield curve on the 2s and 10s will either be flat or uninverted, and that could say something about, maybe we have a problem. One, it's either going to be the Fed's going to cut soon, but if they don't, all that is going to say is that credit risks are now going to be much, much higher as we start moving forward, if we start to see this scenario play out. So it's pretty interesting, but these were a lot of the factors we talked about on stream. I really hope it helps because, like I'm telling you, we are going to talk about the yield curve uninverting probably at a future moment. Maybe it happens sooner, maybe it happens later. It may mean something, but this is one step, and at the very least, last time we saw these movements, it was around SVB and other stuff, but it's clear the higher rates go on, we start talking 5s and 6s and 7s, a lot of the market is going to have to adjust. So get ready for it, and like I said, I still think the same things here for October. We got to get rid of a little bit more of that selling pressure, but if that data plays out like today, and the bonds keep doing it, we could see a lot more downside. However, if that data does flip by CPI, I'm telling you, we have data this week, and then CPI, and then JP Morgan, Wells Fargo, that's going to be the 13th. The CPI is on the 12th. If that is going to all culminate into a giant snowball, we're going to know the momentum from there, and that will really decide, okay, we should really freak out about these bonds. Maybe we see a breaking point, or maybe it's time to cool off a little bit, because this has been a wild 3 months of selling so far. So, Chad, I hope you enjoy that. I hope that helps, but now let us get into the plays. So, right off the bat, I only have 2 plays. Actually, I got 3. I'm going to mix in another long-term. One, MES. I shorted it in the morning off the data. I closed it really quick. I was like, all right, maybe the dollar and some things. It wasn't going too crazy, but sure enough, the pressure came back. Because, again, we were already down a lot on the yields in the morning, but the pressure continued a lot. So that was the first play. I ended up holding 1 to the long side. I flipped to the upside, losing like 150 on that now. Going to try to get out of it either tonight or in the morning, but it's a smaller, like 1 MES, so going to try to ride that one a little bit, but ideally, if I could get out, it wasn't anything. I want to do the flips is what I'm trying to tell you. Smaller plays if we've been getting it, and somebody asked, how do you play this? If you're waiting for the catalyst vacuum, how do you move forward into October and all that? Just play the momentum. I had the right idea in the morning. The data was hot. Again, we talked about that yesterday. You saw a big reaction. The market even went down with it. The first short was the idea. I closed it too early. Try to go for the upside. So, like I'm saying, we'll be down to start fresh with this depending on how we close that tomorrow. But playing back and forth with the data, I think next event, you're going to have ISM tomorrow, European PPI. If that makes the bonds go up, I would just ride the wave. The market's probably going to go down. There will be a time, and that is the caveat to this. This is another thing that we discussed, and you have to be very cautious here, but this will last for a little bit. So I'm telling you this now, but there will be a time it's not going to work, and you're going to get very, very mad at me. But what I want you to see is in October, the same thing. When we were dumping in October, same exact things happened to bonds. I want you to see right now here. I know you might be sick of the chart already. I've showed you this with October, but what I want you to notice is the dates and how it played out. But like after like October 13th, that was the very low. Here's the 19th. You could even see the market on like October 28th, and then it dropped a little bit. Then November wasn't that good, but then we ended up going up, right? So let me show you this one more time. Here was the 10-year during that moment, October 4th, 5th. We started running up, and then that peak there, that day we had CPI that came in 9 point something. That's a reason for yields to go up. It was at 3.94, and then as the days went on, we rocketed up past 3 or 4. We got to 4.23, 4.25, then started coming down, and then by that November, it hit it again, and then as the rates started to drop, the market started to rally. But what I'm saying is, play the data, but you'll even see in October, we had a similar freak out. You went from 3.6 to 4.2 all in a very short amount of time, but like halfway through, it sparked a rally, even though the yields started, remember, this is the market October 13th, then he started to go up there, the yields kept going, and that means the market started bouncing even though the yields kept rocketing. So keep that in mind, but going to be watching some of those flip plays. That is play number 1. Then play number 2, this is the only final play I'm going to be looking at. Intel, they had news, they're separating, it's like their PSG unit or something like that. It's one of their units. I'm pretty sure it's related to the AI, but they're separating it from financials. They're going to IPO it. They're going to take it off of the balance sheet. So people got excited about it. It sounds good. They were mentioning words, restructuring, or what was it? Not restructuring. I think it was like rebuild or something like that. But either way, there's a lot of headlines around this. People liked it. The only problem is I flipped Intel at like way lower and then sold it at like way higher prices prices even recently. So I think they're doing very well, especially compared to like Nvidia and AMD. So it could be an outperformer, but until we get more clarity on the market, that's why I'm kind of limiting the plays, and maybe we go back to some of the respond to the data, then go from there. But Chadadonia, that is all I have for you. It is going to be wild. Hopefully data in the morning calms us down. It's like 30 minutes after the bell. You are going to get PMIs, and then you're also going to get the ISM services. So hopefully we get stuff, but watch for the bonds. I hope you're ready. But that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, keep the branches that produce the fruit. Cut the bad ones. But at the end of the day, focus on the discipline and your responsibility to your time and schedule, ladies and gentlemen. I hope you got the philo. I hope you're ready to go. And welcome to the final quarter. It's already been the end of the year. Welcome to New Year's, man. We're already there, chat. So I'll see you in the morning. God bless you all. And horn.